Okay, well my name's Paul Mahoney. I'm the Managing Director at Nova Financial. We're a finance and property investment advisory company. And obviously the title of the seminar today is How to Retire Through Property Investment. I talk quite often. I talk probably 2 to 4 times a month. I like to involve my audience, so you don't mind too much. I'll ask you to get involved a little bit. If you agree with something I say, or you're answering yes to a question, then put your hand up. If you don't, then don't, I suppose. I suppose if we were to start that off, who here likes the idea of retiring through property investment? Who doesn't like the idea of retiring through property investment? Who doesn't know whether they want to retire through property investment? Most of you will like the idea. I suppose that's why you're here. Okay, well, hopefully that's what we can help you with. We're limited by time a little bit, but I'll cover the key points of what we do and where we might be able to help. And I suppose the progression that most people go through, and I suppose most people don't realise they have to go through to achieve retirement through property investment. First, a little bit about myself. As I say, I run Nova Financial. Before Nova Financial, I ran a company called Spring Financial Group, which is a financial planning company in Australia. We took that company public in 2014. And essentially, we were financial planners that realised there was a gap in the market between the very sales-focused estate agents who, will sell you anything, you never really see them again, which is nothing wrong with that, that's their job. But then you had financial advisors who, in the right circumstances, are quite good at advising their clients toward their goals and retirement, but mainly through equities and pensions. So there was no real independent support network or advice available for people who preferred property as an investment option, and we found that most people did. So that's the gap that we aim to fill. And we found that people liked that approach, liked that the idea that we didn't have anything to sell, but we were trying to help them achieve their goals through property. Now, the UK market's very similar, the culture's very similar, and now Nova Financial has a fairly similar business model that's slightly more property focused. I've spent the better part of a decade not only advising clients, but also studying the latest techniques to help my clients. And now we have a strong team of advisors based here in London. We've also got offices in Manchester and Birmingham. So our plan is to sort of help our clients achieve their goals through property in the best way possible that's kind of suitable for their situation. Start off with a bit of housekeeping. We are an FCA regulated company, so it's very important for me to state that anything I say today is very much general in nature. It's not personal to your situation, and you really shouldn't act upon anything that's personal to your personal situation. Attending seminars, reading books, all of that educational stuff is great, but there's no substitute for personal advice, and that's certainly something that we can help you with if you like. Obviously on a one-to-one basis. So the agenda for the seminar. I've told you who I am. I'll tell you a bit more about who Nova Financial is and what our sort of new approach is all about. It's probably the most common question is, what's this new approach all about? I'll take you through some basic concepts. I know there's probably some people here with some varying levels of experience, so we'll just make sure everyone's on the same page. Ways to retire through property, planning your retirement, and then kind of how many properties or how much money is that going to be, and what's your goal? What are you working toward? Because we find that probably the most common thing when we meet with people is they don't really know. They're not really sure. They know they want to invest, they know they want to build an asset base, but actually having a clear written goal we think is very, very important. And at the end, obviously I can answer any questions you might have, and I'd really appreciate some feedback so that we can continue to improve these seminars moving forward. So, who we are and what we do, and what really makes us different. I mentioned before the new approach. Now, what that's all about is kind of taking the sales out of property. Now, you deal with an estate agent, you deal with a property marketer, you deal with anyone who's selling a property. It's very, very difficult for you to know what they're telling you is actually right for you. And it tends to be very features focused. This property is great for A, B, and C reasons, and that's why you should buy it. As opposed to benefits focused in that, this is your situation, this is what you want to achieve, and therefore this is the right property for you. And that's very much our approach. We think it's more important to understand you, your goals, your preferences, and then using that as the criteria to find the right properties. And that is our service. We advise on all aspects of property. We help clients through the whole process. We do all the research and due diligence that goes into finding the right properties. We do the finance, we do the management. We take away all the guesswork, and we have much stronger resources available to us than really, I would say, any one individual. Our qualifications, well, I'm a qualified financial advisor, mortgage advisor. Our team have over 100 years of experience between us. That's just our management team. I'll go through that very briefly at the end, but that brings a very strong network and relationships in the market, which opens a lot of doors and gives us access to the best of what's out there. Okay? That's enough about us. Some basic concepts. Just make sure, as I say, everyone is on the same page here, and you know what I'm talking about. Passive income. So passive income is income generated from investments without you necessarily having to do anything. We do tend to specialise in the more passive style of investing. Most of our clients are what we would call mum and dad investors of varying levels of wealth, from first-time investors through to high net worths, and probably even people you consider ultra high net worths. But people that are looking to provide for retirement without necessarily having to make that their full-time job. Debt-free properties is obviously properties bought with cash. Leveraged properties are properties that you buy with a mortgage. Positive cash flow property, that is a property that generates you an income after all expenses. The opposite of that is negatively cash flow properties. And that's a very important thing to understand when it comes to planning for retirement. You know, is cash flow important for me at this stage or not? And when will it be important for me? And that's something I'll talk about more in a moment. Buy-to-let mortgages, interest rates. Obviously, buy-to-let mortgages being the mortgages available to purchase buy-to-let properties. And interest rates are an important consideration. What are the rates available now, but what are the rates likely to be in 5 or 10 years' time? And always making sure you're stress testing those numbers, or having someone like us stress test those numbers, so that you're confident that you're going to be in a position to maintain your investment, especially as your portfolio starts to get larger. Rising interest rates can cause a bit of a domino effect, meaning you can lose all of your properties. So if you've stress tested that and you're comfortable and confident that within a realistic range, you're going to be in a position to maintain your investments, that's quite important. Income is taxable. Well, yeah, of course, you know, all the income minus your expenses at the moment is taxable. Currently, all expenses are tax deductible. There are some changes coming into effect as of 2007, April 2017, through to 2020, which changes the tax deductibility of mortgage interest. That's something that's well worth getting advice on, and something that we can help you better understand how that might affect your current investments, but also your future investments, and how you should structure your properties from a tax perspective. A lot of our clients have been investing through limited companies of late, and that pretty well applies, well, it's worth assessing for anybody who's earning more than £45,000 per annum on a yearly basis. So that's worth looking at. Has anybody here looked at their tax position recently, given the recent tax changes? Yes? Have you found a solution to it? No? Well, look, that's something we can help out with. Sorry, let's skip a bit there. Obviously, income in the form of income and/or growth. And that's a key consideration here when we're talking about retirement and working toward retirement, is what is the most important type of return and at what stage of life? I'll talk about that more in a moment. So, ways to retire from property. Now, the three key stages of anyone's life is the accumulation phase of their life, the transition phase of their life, and the retirement phase of their life. Now, the accumulation phase of their life is about building an asset base. That's when that's when you start from nothing to building the assets that you need to generate you the income that you're going to require at some point in the future. Now, at that point in time, generally, the most important type of return is capital growth. Where we see a lot of people go wrong here is targeting income as the main form of return right from the start, which means, you know, if your properties aren't growing in value, then that's all the income you're ever going to get. So as an example, let's say you've got £50,000 and you invest that £50,000 into a property that's yielding you 10% net, which is kind of a pretty good return. That's going to give you £5,000 a year. Now, unless that property grows in value, you're only ever going to get £5,000 a year, which means to achieve your long-term goals, you're going to have to save lots of £50,000, which is double the average income in the UK. So that's going to take a very, very long time. If we compare that to an example of investing that £50,000 into a £200,000 property with leverage, and that £200,000 property doubles over a 10 or 15 year period to £400,000, well, all of a sudden you've turned your £50,000 into £250,000. And as you go, you can remortgage, you can pull equity, and you can continue to build your portfolio. That is, I would say, the most sort of practical approach to building your asset base in the accumulation phase of your life. I'd say probably the most common figure people throw at us between a couple when we ask them what they'd like to achieve in retirement is about £50,000. I'll take you through some numbers in a moment, but to generate £50,000 using a 5% net yield on a yearly basis, which is generally fairly achievable regardless of the economy, you require an investable asset base of £1 million. And most people think, well, £1 million, I've only got 50,000. And you can understand how difficult it's going to be to get to $1 million by saving lots of 50. But by investing in properties with growth potential, remortgaging and reinvesting, that becomes a lot easier. Once you've got that £1 million, for example, what we find is, we meet with a lot of people who, especially, we're based in London, we meet with a lot of London-based investors. They've got £3 million worth of property, but it's yielding 2%. The yields in London aren't very good at the moment. And they're saying to us, I've done the right thing, I've built this asset base, but I'm just not getting the income I need. So the transition phase of life is about reassessing your portfolio, making some changes. Now that can be through selling down, or it can be through remortgaging, better balancing your portfolio from an income perspective. But these are the things we help people assess. Look at their situation and assess what their options are and what's most suitable for them, not just from an investment perspective, but also what they're comfortable with. Investing isn't just about money, it's about peace of mind and sleeping at night as well. Now, if you've done those two phases of life correctly, then retirement should be easy breezy. That should be where you enjoy yourself. Unfortunately, that's not very commonly the case. So it's very important to make sure you plan these three stages correctly, understand what stage you're in, understand the timelines you have to work to or that you'd like to work to, and set goals and work to them. Again, that's something that we help our clients with on a daily basis. Choosing a strategy. There is up-to amounts, different amounts of strategies that you can take in investing in property. I've mentioned one about investing in growth properties, remortgaging, reinvesting. Obviously, there's things like HMOs and buying, renovating, flipping. There's a range of different strategies out there, and I would say the best way of choosing one is talking with someone who knows what they're talking about, who's done it before, who has the experience, not just in one area, but talk with a few different people who've done each of them, and decide what you're most comfortable with. Decide what works for you. How much time do you have on your hands? How much do you want to apply to this? And I don't think there's any right answers to that. And I don't think any of those strategies can necessarily do better than the other either. We've seen clients do just as well out of each of those things I've just mentioned. So don't just believe the hype that HMOs are the best things in sliced bread for everyone. How much money will you need to live? That's an important thing to understand. One of the first things we say to clients when we meet with them is, what's the end goal? How much passive income do you actually want or need? And when would you like to have that? We go through a bit of a discovery exercise. We go through all of your financial position. What's the end goal? What's the time frames? And often, that's enlightening for people. They've never done that before. So it's important to know where you are now, where you want to go, and then working out how you're going to get there. And that will determine what sort of portfolio you need to be building. And perhaps that will have an influence on the strategy you choose as well. So, planning your retirement, so you don't end up like this guy. So we've spoken about building the portfolio, the different options available there. I could talk all day about that, but that's not really the focus of the talk today. The options that you have from there though, but once you have built the portfolio, let's say you have the £1 million or the £3 million or whatever you need, because everyone's situation is different. You know, I mentioned 50 grand being the end goal. Some people wouldn't spend that in 3 years. Other people would spend it in a weekend. So, you know, it all depends on your situation. But really the three options you have at that point, when you have built the portfolio, obviously you can sell it. You can take your £1 million, you can turn that into cash, obviously there'll be some costs involved there, but then you can do with it as you will. You can put it in the bank, which, you know, obviously generally at the moment wouldn't give you a very good return. You can invest it in the equities markets, you can invest it in different types of properties that are higher yielding. You know, we have some clients at the moment that are getting cash on cash yields of 12 to 15%. Explain cash on cash, that's the money you put in. So let's say you put in 50 grand and you've borrowed 150 grand and you're getting 7.5 grand after all expenses. That would be a 12 to 15% cash on cash yield. And that's them borrowing at 2% and achieving a yield of about 8%. Now, you know, whilst you can do that, and that's the current market, it kind of makes sense to have some level of borrowings regardless of what your goals are. And I'll talk about that more in a second. But you can sell up. You can maintain your portfolio. You can stand strong. This is my baby. I've built it and I'm sticking with it. That's fine if if you've built the right portfolio that works for you and gives you the income you need. But generally we find that there's some tweaking to be done. Or you can maintain your current portfolio and you can remortgage that portfolio, pull some money out, invest it into some higher yielding assets and balance out your portfolio. Now you can do that to different degrees of risk, obviously. You could leverage yourself to the hilt if that's what you want to do, or you could take a very small amount of leverage. You know, we're in London now. I'm not sure how many of you from London? How many of you aren't from London? So about 2/3 of London. All right. A lot of people in London don't realise that, you know, you can take 20, 30, 40, 50,000 pounds and buy a pretty decent property in the north of England that will give you a fantastic yield. So that's something worth looking at, because generally we've found that over the past few years people in London have done quite well from their properties. And in the right areas in north of England as well, of course. But at that point you can rebalance your portfolio. Aim for that income that you need. You don't necessarily need to sell, you don't necessarily need to mortgage yourself up to the hilt, but there's options available. Okay, I'm going to go through some numbers. Now, can everyone see those numbers? Not too bad? Okay. Good. So, this first example here is a debt-free example. This is assuming that cash purchases or the debt's being paid down. So, I spoke before about 50 grand being the goal, and that's not even there, but let's work on the 60. Okay? So let's say 60 grand is your end goal. Now, I talk about retirement, but when I say retirement, I actually mean financial freedom. Because, you know, some people aren't interested in retiring. I don't think I'll ever retire. I'd get bored. You know, you have to do something with your time, but having the option to retire. So let's say to do that, you need £60,000. If you were generating a 4% net return, or net yield, because obviously different types of returns, capital growth isn't all that much good to you when you're just looking for income unless you're going to sell. So we're talking about income here. If you're generating a 4% return, you're going to need a net asset base of 1.5 million. If you're generating a 6% return, you're going to need £1 million. So if you look at 20, you've got 500 grand and 333,000. 100 grand, you need 2.5 million and 1.6 million repeater. So that gives you an idea. If your goal is to work on a cash-only basis, then that's what you need to be working toward. Bit of a summary there on the 100 grand. And that obviously differs when you choose to take leverage. So these two examples here, can everyone see that still? A little bit smaller? Yeah? So 50% leverage. So I mentioned before about not necessarily leveraging yourself up to the eyeballs, but taking some leverage. This is 50%. An average property price of £200,000. People in London might think that wouldn't buy you a garage, but it would buy you something pretty decent outside of London. A yield of 4% and an interest rate of 3%, which is above market at the moment. But the better buy-to-let mortgage rates at the moment are around 2%. Okay, same examples though. This time we're working on multiples of properties. So you've got 2 properties to 10 properties. Therefore, the value, the debts on those properties, given that it's 50%. The mortgage repayments based upon your 3% interest rate. The rent that you'd receive based upon your 4% yield. We factored in some maintenance, because obviously properties aren't free to hold. Now, the net rent on the 6 properties will be $27,600 with the 50% leverage. On 10 properties, it will be 46,000. On 2 properties, it will be 9,200. So what's interesting about that is obviously, even on the 4% yield and 3% interest rate, you're not too dissimilar there. You're still getting a much better yield on £1 million than you would without the debt. Now, if we went for a 6% yield, so all of these numbers are exactly the same as those numbers. The only difference is the yield is increased by 2%. And as you can see, when you compare these figures to these figures, it's significantly more. So the yield hasn't doubled. The yield has gone up by 2%, but the income has nearly doubled. So going back to what I mentioned before about being able to borrow at 2% and achieve yields of 7 to 8%, if that can really help you boost your cash flow, even when you're investing in properties that have a lot of growth potential. Next example. Now, this factors in the risk of rates rising. So before we were looking at a 3% rate. Here we've doubled the rates from 3 to 6. We know all these figures. Now, if we're getting a 4% yield and a 6% interest rate, as you'd expect, the net income comes down. If we go back to the next slide, if we look at the top one, 46,000 comes down to 16,000. However, they're still maintaining themselves. A 6% interest rate, just to put that into perspective, would be a significant increase from where we are now. We're at base rates of 0.25%. They would have to, there'd have to be a very, very strong run on interest rates for us to get anywhere near 6% in the foreseeable future. But it's worth looking at. Now, if your property is yielding 6%, again, very, very achievable, and you're paying the 6%, which is probably a bit higher than what you'd expect anytime soon, the yields are still very, very good. If we compare those figures to the 4% yield on the 3% interest rate, they're better. So even with the rate doubling and the yield increasing by just a third, you're in a better cash flow position. I think that's quite interesting, and something definitely worth considering when it comes time to preparing for income from property being your main source of income. So a summary on that. Obviously, debt-free property in retirement is the most conservative strategy. Leverage enables you to increase your income, but there's more risk. Now, so long as you're doing this stress testing, I think you can mitigate that risk quite well. What's the best strategy for you? It very much depends on your situation. As I say, it's worth seeking personal advice. Whether you listen to that advice or not is completely up to you. But it's worth seeking out the tools to make an informed decision. Very quick study, which some of you may have seen. So there's a study done on Harvard MBA students. Okay? And they asked these students if they had clear written down goals. 3% of them said they did. They were clear and written down. 13% of them said they had goals but they weren't written down. 84% of them said they had no specific goals at all, so they didn't really know what they were doing. 10 years on, the 3% were earning 10 times as much as the 97% combined. Now, you might say to me, what the hell has that got to do with property? My point is, you should have clear written down goals. This proves that point. Seek out someone who specialises in doing so, write down your goals, understand your situation, and then do everything you can to work toward those goals, and you'll have a much better chance of getting there. We're running a promotion for the show where we're offering we always offer a complimentary meeting in our central London office. If you're outside of London, we can do those in our other offices or via Skype. And that's to give you a more clear understanding of how we might be able to help and our approach to property. If there is a fit between what we do and what you're looking for, we usually charge a fee which ranges between £500 and £2,500, depending on the complexity of the client's situation. The promotion we're running for the show is we're offering to waive that fee. So that fee is usually for putting together a recommendation on how you can improve your situation. It's the culmination of 2 weeks' work on your situation, on where you should go from here. So there's no obligation to proceed with that. There's no cost. So there's not really an awful lot to lose aside from a couple of hours of your time. I suppose worst case you walk away with a lot more information on what your options are. If you do proceed with that recommendation though, we're offering a range of other inclusions. So full lettings and management UK-wide for just 7%. First year rental guarantee at whatever rent we say you'll achieve. 1 year subscription to Your Buy to Let, which is a landlord software. The first year's landlord insurance for free, and a full portfolio review of all of your other properties and all of your finance to see if you can make any improvements. So that's the promotion we're running. If you'd like to qualify for that, you can fill out the feedback forms, see us at our stand, or give your name to my colleague at the back. A couple more things before we finish up. We also offer a range of educational guides. That's 3 of them. We just launched another one today. We're launching another one next week. They're a great starting point for sort of beginner to medium level investors. They're not high level, they're very easy to understand, but they're very educational. I wrote them, so. Just to give you an example of a recent success story. We had a few clients invest in a development in the Birmingham city centre in January of last year. They were mostly 1-bedroom apartments around the £100,000 mark. That development completed in February of this year, and those same properties were selling for £150,000. So a 50% uplift in 12 months. One of our clients bought 4. He sold 2 at completion. So he put in 4 lots of 30 grand, which were 30% deposits, 120,000. He took back 160,000, and he still has the other 2 properties that are yielding at about 7%. So that's an example of where some of our clients have done extremely well recently. That's just one example of one type of investing, obviously. I'd love to say it's because we're geniuses. It's not necessarily, the Birmingham market's done very well in that time, but it does justify the research we did to position them there. We have loads of happy clients. You can look at it on our website. We've got videos. We've got, feedback from clients. So, that's always nice that our clients value the advice we're giving, and hopefully we can be of benefit to some of you. I mentioned before about our management team. This is them. Again, it's all on our website, but this is where the advice comes from. I spoke about myself. David Alberto has bought and sold billions of pounds worth of property, mostly in London, but all around the world. It brings a wealth of knowledge. Ian is a chartered surveyor. He ran one of the largest surveying companies in the UK for 15 odd years. Julian's a qualified accountant. Giles is also an FCA approved person such as myself. That's where the advice comes from. That's the people that, if you choose to engage with us, we'll be providing you with the advice. Okay, lastly, so there's some feedback forms. I think they're on every second share. They should be enough for everyone. I'd love if you could fill them out for me. And on the bottom of those forms, you can also apply for a meeting, as I say, whether that's in person or via Skype. And does anyone have any questions? Questions?
How much is your ongoing service cost?
Good question. Obviously, as I say, we waive the initial advice. For managing your properties, we charge 7%. But generally, 99 times out of 100, if we source a suitable property for you from the market and you proceed with that purchase through us, we receive a fee from the vendor. It's very similar to the way an estate agent is paid, but the difference between us and an estate agent is we don't have a book or a list. We have access to the whole market, and we pride ourselves on doing so. So everything we do is bespoke to the client. What we do have, though, is very strong relationships in the market to get access to the best of what's out there. Pretty well anyone in the UK will pay us a fee for delivering a buyer and facilitating a sale. That's fully disclosed and transparent, and that way we don't affect your cash flow whatsoever.
What is your retirement plan?
My retirement, personal.
Are you part of the
Oh, of course. You know, I'm a property investor myself. Obviously, my situation is probably a bit different to some of the people in the room, but you know, very similar to all the things I've been saying here. You know, we live by our, I was going to say sword. I don't think that's the right saying. we live by our advice. So we very much followed ourselves. We're all investors ourselves. And yeah, you know, we invest in very similar types of properties to what we advise our clients invest in. Anything else?
Is it a range of types of properties? Is it residential? I mean, I've got quite a mixed portfolio.
Yeah.
Healthcare, hotel, student, etc. So would you be looking for sort of residential properties?
Well,
or a wide range?
we tend to focus on residential by choice because we find that's what works for most people. For example, I mentioned David and Ian. Their background is very much commercial property. So we definitely have the expertise in that area. But we find unless the client is has a fairly large asset base and cash available to them, that commercial property can be more risk. So obviously vacancy rates are higher. If you're taking leverage, you need to be able to support that period. So the answer is we can do everything, but we tend to focus on residential due to our clients' requirements.
Do you tend to also help with the buy-to-let, arranging the buy-to-let mortgages?
Yes, so we're an FCA regulated mortgage advisory company.
I'm just out of interest at the moment, because I've not done a buy-to-let before, what's the sort of minimum capital required to do
The
the
minimum?
minimum loan and the minimum amount to put into that?
Oh, and if you don't mind handing those feedback forms to my colleague, if you can, that'd be great. The minimum, so the minimum capital to apply.
Well, for the loan, I mean, is it 50,000, 100,000, 70,000?
Oh, well, there's no minimum in pound terms because it depends on the price of the property.
I understand that, but okay, maybe it's changed since I last did.
Yeah, so the maximum loan to value that buy-to-let lenders will go to is 85%. However, the rates become quite expensive at that end. The standard practice buy-to-let loan to value is 75%.
Yeah.
Some lenders will go to 80, still at fairly competitive rates.
And 2% is realistic.
That's kind of best of market at the moment. I think the best buy-to-let mortgage rate at the moment is 1.76%, and that's at a 60% loan to value. Obviously, it kind of increases from there depending on the property, the client situation, the loan to value, etc. Any other questions? No? Don't be shy. Don't bite. Yep.
There are lots of changes.
Yes.
Particularly with stamp duty, complexities in getting a buy-to-let mortgage.
Yeah.
And there are question marks about what is the best structure, whether it's limited company.
Yeah. So just to repeat that question for everyone over here, there's been lots of changes around tax and essentially buy-to-let in general is changing. And what's the best way of structuring investment? Is that right? The answer is kind of what I mentioned before. It very much depends on your situation. I'd love to give you a definitive answer, but
As a basic rate taxpayer.
as a basic rate taxpayer, you're still better off in your personal name. The reason for that is so long as your employment income and your property income doesn't exceed £45,000, the recent changes to mortgage interest deductibility doesn't affect you. Because they've changed it to being a tax credit at 20%, which is the basic rate of tax. Therefore, you're excluded from the change. If you earn more than £45,000, then anything over £45,000 will be subject to the change. And that's why a lot of people are exploring the option of investing through limited companies. And that's kind of the threshold as to when you should start thinking about that option and whether it might be suitable.
Is there much difference, again, for us, since I've done it through buy-to-let, but with a limited company getting a mortgage at those better rates, or is that more?
Yeah, there is still a bit of a difference. The rates for limited companies are progressively coming down. They were not so long ago quite expensive. Even if we go back 6 months, they were about 4%. and now they're
At
about,
the moment, I did it 2.5 years ago. So.
yeah, so now they're about sort of 3.5 or a bit below 3.5. There are some better rates at lower loan to values, but I'm talking 75%.
So you've got 50% loan to value.
Yeah, you can get rates around the 3% mark. So they're becoming a lot more competitive and a lot more aligned with individuals, which, to be honest, in my opinion, makes sense because the lenders ask for a personal guarantee anyway. So from a security perspective, there's no difference to them whether it's in your name or a limited company. But because it's still a bit of a niche, there's not as many lenders doing it. As you know, as competition increases, they need to sharpen their rates, and that's happening at the moment. BM Solutions, who control a quarter of the buy-to-let market, are talking about moving into that space. And when they do, I'd be surprised if their rates are any different to their individual rates.
Would you work with overseas-based investors? And if so, what would be the difference in approach?
Yes, we do work with overseas-based investors. We have a bit of a presence in Hong Kong. We conveniently line that up with the Sevens every year. But yes, we do. We work with overseas investors that are both cash buyers and that are looking to raise finance. Obviously, there are specialist lenders that cater to people living overseas, and the rates and the criteria differs depending on the buyer's situation. In that, for example, if they're an expat with a presence in the UK and they own property here and they're a high net worth, well, that's quite a good situation. If they're from a third world country and they've never been to the UK and they're not in a very good financial position, then that's a very difficult one to do. And then there's kind of everything in between. Okay. Any other questions? Yeah, all right.
I also have a financial advisor, so how would you see your role on the property side?
Yeah.
They don't get involved in the property side. Is there any
No,
potential conflict? Or
we work with a lot of clients who already have financial advisors or already have even mortgage brokers. And the services that I described, that's not set in stone. Everything we do is bespoke to the client. So we fill the gaps essentially. Something that our clients do tend to like about our service is that it is very holistic and they can have everything in the one place rather than dealing with 6 different professionals. That can be beneficial not only because not only because it saves you time, but also because we can make sure the different areas of your finances are working together. The issue we find is when you have an estate agent, a mortgage broker, a tax advisor, an insurance broker, all those different professionals that never actually talk to each other. And most of our clients aren't experts in any of those things, but they're the ones that are expected to join the dots. So, for example, you go and speak to an estate agent to select the property and you buy it. You then go and speak to your mortgage advisor about getting the finance. You then go and speak to your accountant about your tax obligations. Now that property's been selected without even considering really whether it makes sense from a finance or a tax perspective. So that's a good example of how we bring those things together. Anything else? Any other questions? No? Going once? Going twice? Okay, thanks very much for your time, guys.